Okay, so Pippa, just walk us through this. What did it price at? It opened at 30, so we're a little below the open price for the public.
Yes. So the initial targeted range was $16 to $19 per share. Then last night they upsized that thanks to strong demand. They ended up pricing at $23 per share. Then today at the open, they opened at $30.11, surging more than 30%. They got as high as $31.33, and now we're right around $27, so a gain of 17.5%. So maybe a little bit above where the company would ideally like to see the price trading today, because you never want to think you left money on the table. But they still raised more than $1 billion.
Guys in the back, can we see the two-day chart on this so we see the open relative to where it is right now? Just I love the tick, don't get me wrong, but just if we can see the
raised $1 billion. Ken Griffin, the founder of Citadel, is doing quite nicely. $100 million personal investment on this one. He's set to gain about $300 million. We could relitigate, Pippa. I encourage everyone to go back and watch our segment yesterday. Steve and I's thoughts about the nuclear prospects here. Or we could talk about, and maybe we should talk about what's going on in the Strait of Hormuz. And maybe this is, the market has decided that the issue is, I don't want to, Steve, maybe I'm putting this too strongly, that the issue is effectively settled. But it is far from settled. And so what do we know at this point?
It is far from settled, and it's really interesting to talk to people within the industry and then talk to more generalist people in the market, because there is a very wide disconnect with everyone in the industry saying this compounds daily, this is getting worse and worse, and this is not going to be solved anytime soon. We're starting to see some projections of people saying, months by the end of the year. The timeline just keeps getting pushed out. And JP Morgan had a really good recent analysis today that's getting a lot of pickup here. And basically their point was that the supply shortfall is now so large that the only option to balance this market is demand destruction. And so typically the four levers are: first, we see spare capacity. That's not an option this time around because Saudi Arabia and UAE had that spare capacity, and that is behind the blockade in the Gulf. So that wasn't an option. Then you have inventory draws, emergency releases, and finally demand destruction. And by their math, stay with me here, we have lost 13.7 million barrels per day. We've seen inventory draws of 7.1, demand decline of 4.3. That still leaves us 2.3 million barrels per day short. And so what they say is that demand destruction will have to come from the U.S. and Europe, and that means higher prices.
Okay, I got a problem here because I'm looking at the EIA, which is the U.S. data, and I'm going back to, I don't know when, wherever I want to go back to. I see no production response in the United States. We're still at 13.5 million barrels a day. Mm-hmm. And I got an armada of tankers coming to the United States to fill up. They're going to fill up 1 million barrels a day.
Wow. An armada?
An armada.
A flotilla, armada.
It's a flotilla-mada. It's unbelievable. It's so big.
There's more than 70.
It's a mega flotilla-mada.
That's right. So there's more than 70 VLCCs. That's very large.
Very large.
On their way. Yeah, 70. And usually at any given time, it's 27. So this is from Kepler.
And how many? What's the number now?
More than 70. Compared to 27
These are
typically.
Thirsty, hungry
They're
VLCCs.
thirsty. They carry 2 million barrels of oil, so that's a lot of oil. Yes, but before we start sounding the alarms here, there are limits for our exports because of infrastructure capacity issues. So, last year we exported on average, call it 4 million barrels per day of oil. Maybe we get up to 5.5, 6, but after that, we are tapped out. There's not enough infrastructure. So it's not like all of a sudden all of our production will increase. But to your point, Steve, we're seeing the rig count actually go down. We're not seeing a supply response, and we probably won't see a big supply response because look at the shape of the curve.
So we're reshaping global oil flows. 70 ships
temporarily, at least. It's 15 extra days around the Cape Horn.
It starts temporarily.
These poor sailors got to go around Horn and then back around.
And also think about the cost of the fuel to ship that, because then you can't just look at the price of oil anymore. You also have to look at the transport. The money that you're not making when it's in route and not at its end user, and the trading. All of these things, just the market is being physically reshaped. There's no going back to
the point I wanted to get to, Pippa, is whether or not you take whatever it is, 1 million extra barrels out of the U.S., doesn't there have to be a U.S. price response?
Well, we're talking about 14 million barrels on all of these ships. If that, yes, it's.
What Pippa's saying is that you can't fill them up even if they wanted to.
Not every day.
Not every single one. Not consistently at that level.
So the constraint limits how much they can take and how much. But there is this, at least, what did you say, extra 1 million barrels a day that can be taken out from the U.S. Doesn't there have to be a supply response? And is that in the market now?
Well, so what happens is that won't necessarily translate to what we see on our screen, because if you think about it, if there is a limit to how much we can export, then there is a limit on how much people will pay domestically. But then if you talk about the traders in Asia or other nations that want that oil, it's maybe the middleman that might see the most increase here, because ultimately there is a ceiling on U.S. production. But then you also have to think about the fact that all of our oil, or a lot of it is exported, I should say, from the Gulf Coast. And you look at California, they're not connected to the rest of the U.S. via pipeline. They're called a fuel island. They're importing from South Korea, which is now curbing their exports. So the main point here is that just because the U.S. is the world's largest energy producer, these are global markets. It's a fungible commodity. And also, we are a net energy exporter, but we are a net crude importer, because we are exporting a lot, but we are also importing those distillate barrels, the distillate-rich barrels we need.